If I was talking about capital stack and some general rules, I would always err towards being a little bit more conservative in structuring capital stacks. Real estate's very capital intensive. And when things are going well, it's amazing. And that often happens. But if you think through what I'm talking about with seniors and mezz lenders, et cetera, when things go just a little bit bad, it's really easy to get hurt, particularly if this is happening on a few different projects. So if I was like looking at this big picture, I would say there's often a lot of like internal emotion. You can convince yourself like, oh my God, this is going to be the greatest property in the world. It's going to be amazing. I'm going to make this and that. But I think to exist in this business, to last in this business, to compound your interest in this business, I think you want to be conscious of that and pull yourself off that and take a little bit less risk. That's what I would say when you're in the real estate business, because there's always going to be a rainy day and you don't want to be without an umbrella when that happens. You need at least half an umbrella. Today, I want to talk about real estate finance 101 and really talk about what we call the capital stack. Okay. This applies to acquisition or development of pretty much all types of property class: residential, hotel, commercial, office, retail, industrial, doesn't matter, right? Capital stack is basically all the money or credit, in a sense, that the cash or credit that's going into an investment, right? It's all the money essentially. And as we all know from some of our previous talks from Business Untitled, you're not always putting up all the money yourself, right? There's a big concept, other people's money, OPM in this world, right? And so the capital stack is basically breaking it down into a few different tranches, if you will, to help better understand that. I'll start by saying finance is complex. America, United States is the best at it. There's just infinite financing structures and strategies. But we don't want to talk about infinite today. If I'm going to talk about basically how to look at a capital stack and how to conceptualize it, right? It's like, starting with a language, right? You want to get the building blocks first. Senior debt is the least risky piece of the equation. It's also the piece of the equation that gets the least return on the investment, because risk and return correspond with each other. And so senior debt, everybody knows what that is. That's the big banks. That's Wells Fargo. That's JP Morgan. That's Bank of America. That's your regional banks, Silicon Valley Bank or Republic or any of those guys. It's basically what you know as a bank. And they're making a loan. What are the key pieces of that loan? Well, we're going to talk about that. Okay. Number one, they don't leverage higher than a conservative amount in the total cost of that asset, whether it's development cost or acquisition cost. So if something costs $100, a senior lender is going to lend $50, $60, maybe $65, 65% on that, right? 60, 65. It can depend on what the asset class is, what the investment climate is, but essentially they're protecting themselves and saying, look, we're going to only loan 60% of the value of this asset, and we're going to get paid back before anybody else does. And because our money's the safest and we're not loaning all the way up to the full value, we will take a low rate of interest. The security that let me talk about low rate of interest. A low rate of interest is effectively going to be priced somewhere above what government treasury debt is priced at. So I'm not going to get into that right now, but a low rate of interest does change over time, but it's going to be something like 1.5%, 2%, 3%, depending on what the industry and the asset class is, over what a government bond or government paper will be priced. The security or the collateral that a senior lender takes is a first lien, a mortgage on the property. They are in the safest position. When the shit hits the fan, all the money goes to them first, every single dollar, before anybody up the capital stack gets any other dollars. What is mezz debt? Well, mezz debt is a second piece of debt that is put on the property. I'm going to talk about what the collateral is for that in a second. But the mezzanine debt, and think of where a mezzanine is located relative to the floor seats, right, at the garden or at a concert. it's up above a little bit. So it's a little bit less secure. It charges a little bit more interest. It's paid back after the senior debt. So if the shit hits the fan, senior debt gets paid 100%. Next, they start going to the mezz debt. Banks that you know of, commercial banks, are typically not the mezz debt lenders. It would be opportunity funds, your Starwoods, your Blackstones, your Canyons, could be people you never heard of. But essentially, they're usually sitting somewhere between 60%, which is, we talked about where the senior lender ends off, and maybe 80%. Sometimes it could be 85%, sometimes 75%, but it's taking more risk than the senior, but not all the risk. Okay. And so instead of pricing 1%, 2%, 3% over a bond, over the government bond, as we talked about with senior, this might price 7%, 10%, 12% over that risk-free rate. The other key distinction with mezzanine debt is and this is a little bit complicated, but I'm going to say it, the security that is taken in the context of a mezzanine debt is not a mortgage in the property itself, typically, but it's a collateral interest, a mortgage. We don't call it a mortgage, but it's a security interest in the ownership of the property. So follow that for a second. When the shit hits the fan, the bank goes into a foreclosure action. They go to court, right? They prove their judgment and they get the property. Mezz lender, it's different. If they go to court because somebody's not paying them what they're due, they have a security interest in the stock, the shares of the property that the owner owns. So the senior debt is still sticking with the property. They're now taking the ownership of the property from whoever that owner was. Now we're going to talk about equity, ownership. Ownership can be just straightforward. One person owns it, one institution owns it. That would be called common equity, basic ownership. There's times when that ownership also gets split, where somebody doesn't have all the money, and so they go and they get a preferred equity piece versus a common equity piece. What's a preferred equity piece? A preferred equity piece is typically from a money fund, an insurance company, a pension fund, a sovereign wealth fund. It's going to get paid more than the senior, more than the mezz, because there's more risk in it, but less than the common equity. So it's going to sit in a position where it's not as risky as the common equity, but it's riskier than any of the categories of debt. And in return for that, the preferred equity is going to get a lot of the returns of ownership, but the more successful the property becomes, what we call a promote will start to go higher and higher to the common equity. So this is the concept of using other people's money, where you can have a little bit of money, you can get a senior loan, you can get some mezz loan perhaps, you can get preferred equity where somebody with a lot of money is willing to take a little bit less return on the ownership side for less risk, effectively. Common equity is basic ownership. Really easy to understand. If you're just taking the most basic, say, real estate transaction of a house, you have a mortgage, that's senior. You have equity or ownership, common equity, easy. You don't have a situation with preferred equity, mezz loans and things like that. But as projects get bigger and more complicated, there are opportunities to tranche that equity up into different pieces, into preferred, into common. But basically, common equity is you own the property, you make the decisions, you take all the risk at the end of the day, effectively, or I should say the most risk at the end of the day, and the most reward if the property works out well.